Next, we are going to dive into interest rates and the differences between fixed interest rates and variable interest rates. Interest rates are going to be a very key component to understanding your student loans and also identifying which loans we are going to refinance and which loans we are not going to refinance. As you can see, there are several differences between fixed interest rates and variable interest rates. One of the first differences is that all of your federal loans are only going to have fixed interest rates. However, for a private loan, some are going to have fixed rates and some are going to be variable rates. Since all of your federal loans are going to have fixed interest rates, we are not going to refinance any of your federal loans. So for the purpose of this course, we are just going to look at refinancing your private student loans. However, we are going to include all of your federal and private student loans in the student loan spreadsheet as we create that. The biggest difference between fixed and variable interest rates is the way the interest rate evolves over time. As you can see, with a fixed interest rate, it will remain the same over the life of the loan. So if it's a 15-year term loan, on day one you take that loan out, the interest rate will be the exact same the day you pay it off 15 years later. However, in a variable interest rate, the interest rate will change over the life of the loan depending on the economy. Now you can look into all the details to what causes an interest rate to change, but for the purpose of this course, we are just going to identify that a variable interest rate is going to change over the life of the loan. And typically that change happens monthly or quarterly. So typically that rate is going to increase with the life of the loan. Now there is a chance that it can decrease, but all of the loans that I have seen and helped refinance over the years have increased by the end term that the loan has gone through. So for that case, we want to make sure that we are looking for your private loans that are variable and refinancing those loans, because what we want to do is lock in those loans and make sure that they don't change over the life of the loan and that your interest rate remains constant. The last two big differences between fixed and variable interest rates is that there is a lot less risk associated with fixed interest rates. This is due to having predictable monthly payments. The amount due on a fixed interest rate loan is not going to change on a month-to-month basis, as well as the total number of monthly payments will not change over the life of the loan. However, since a variable interest rate can change month to month, you're taking on more risk because it can be a change from a month to a month basis on how much you owe on that loan and how many total number of monthly payments you're going to make on that loan could change over time. So what we want to do is mitigate risk by helping you refinance your variable interest rates into fixed interest rates so that you know going into the loan how much you're going to pay over the life of that loan in order to pay it back. Our refinancing recommendation is going to be refinancing any of your high fixed interest rates and any of your variable interest rates into new fixed rate loans. What this is going to allow you to do is reduce the risk that you take on with the loan, lock in your rate so that you know what it's going to be and what your monthly payments will be over the life of your loan, and help you avoid any budgetary surprises. So we're going to lock in that rate for you and help you refinance any of those loans into fixed rates. If you're looking for further information on fixed and variable interest rates, refer to the student loan guide, and that has hyperlinks to good websites that's going to help you identify any outstanding questions that you might have if you're looking to do some further research on the difference between fixed and variable interest rates.